Hello, I am Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. Today we're going to get to use pretty little pictures as I walk through a discussion on budget management, risk management, and how one simple trading combination can yield a multitude of different approaches. So let's get straight into the chart and really deal with some very tasty treats. On the chart, we are dealing with CVC. This is not an asset I would particularly work with simply because of the volatility. It's often more than what I prefer. But it does have some good points to it, especially coupled with Oliver Twist and using two different accounts simultaneously. For example, if you were to take long positions on every single buy signal with very small or fractional amounts, using hyper-aggressive aggregation techniques, you could actually use this as a very interesting approach for penny scalping. The thing about this to be aware of is that this kind of technique can build up quickly, which is fine if you're only doing 1 or 2 CVC at a time. For Kraken's minimum, it's $5 per trade, so it's reasonably easy to calculate out exactly how much you want at a given moment. If you have a futures market, you can use the sell positions to open up short trades. But for the purposes of this discussion right now, we're only going to focus on the long trades. So just with a simple 3 moving average approach, and it can be a 20, 50, 200, or in my case, a 17, 47, 197. All of these positions equal buys with a simple 1% take profit and a 10% stop loss. Because this is going to have a very high level of success, I'm not worried about the stop loss being larger than the take profit. In fact, statistically, it works more in my favor. But this is a situation that does have high risk. And if you've been trading on Jackrabbit Mimic, testing this, you can quickly see just how well it escalates in terms of the amount of positions you are likely to hold and the duration of those positions. So you can scale this up just by adding dollar cost averaging, and it will limit the number of trades you take. So let's see what that looks like. So now I've added dollar cost averaging, and we can see on the right side some of the metrics. It has completed 71 trade cycles with an average profit of 2%. The last profit looks like it's around 3%. So this is quite a generous system, and it's also very limited. For the purposes of this analysis, TradingView provided 683 days of data, and in that period, the largest or most positions that I took on was 10. That's not bad, but we can do better, much better. What if we actually look at a different approach? Let's hide the dollar cost averaging and the moving average and look at the average true range. So we see here on the average true range, significantly less buys And this one is even really an interesting approach because you can buy and sell right off of the average true range. So just with using one indicator, you now have a very nice little reasonable profit system that works well. So even though I'm using 3 indicators total, by looking at different components in different ways, you actually have more trading options than just what you would expect. So in this case, average true range by itself does well. But I have fixed average true range with a little bit of a side gimmick. I've already matched it to my moving averages. So now we can see I have moving averages and average true range, and when they line up, I get purchase and selling points. And that really adds to the benefit of the technique. That is, I'm taking less risk so I can use larger position sizes. Now let's take this one more step and actually set the DCA module to use average true range instead of just the moving averages. So let's go into the settings. Right now it is set for the moving averages, and let's tune it for average true range. And now let's turn it on so that it's visible, and let's turn off the others so the chart looks cleaner. And now you can see the chart has drastically reduced the number of actual trades we've taken. We have taken 4 trades. That's it. So which means now your position sizes can be significantly larger because you are taking on less risk per position. So you can maximize your impact very easily and very simply with a common recipe or a common approach. And the beauty of this is that according to its own statistics, you're only taking on 1 purchase per trade. So it does exceptionally well in mitigating risk. It does exceptionally well in mitigating the number of positions you are accumulating, which means it will manage your budget better. It has better risk management properties, or more specifically, not necessarily better, but more defensive. Because you may want a strategy that uses hyper-aggression for just a moving averages that does micro amounts of positions on a regular basis, which I use quite commonly through aggregation, where I take a whole slew of tiny little trades and then I just let them run constantly. And it works very well. But that's not for everyone. Here you have a very clear, concise, and easy to use system that determines a very finite amount. So let's take a look at this chart. And you can see that because of the restrictiveness, there are a lot of places that it just does not take on positions. And that's the whole point. It deliberately trades small positions at very specific opportunities. And you can see here the 2 positions it took was so in and out of the market that risks were mitigated very, very quickly. So this could have easily been a $100 position, a $200 position, or even a $500 position, and it would have done exceptionally well. But now let's see how it looks on other markets. Here we are on the ADA USD market, and as you can see, it is not as limited as it was on the CVC market. That is, it has 13 positions per cycle so far, and its market analysis is 22 days. So the asset you trade matters. So you need to tune your trading with your asset. I personally would still trade this because this is quite a good system, and it's still very limited. Having only 13 maximum trades per cycle is very good. The average is only 3. So you only have to really be concerned with the few cases that it goes over that. But nonetheless, having this information tells you your risk. Coupling it with Mimic will tell you exactly how it will perform on a longer basis using real world data. And here we see this particular one does 10 trade cycles with a maximum buy of 5 per cycle. But as we've seen, the maximum buys fluctuate with the market, which is fine. Spend time studying your pair. Forward testing it with Mimic is an exceptional way of getting the kind of data you need to be able to determine whether or not you have a pair that is going to be long-term sustainable. For me, I personally like any pair that has under 20 positions, and sometimes depending upon the pair and whether or not I really want in that market, I will accept up to 100 positions at small values. Always remember, whenever you have more positions per cycle, smaller amounts per position. That way you can limit your budget and keep it controlled. Where you could actually use, for example, a $100 budget would be $1 per position if you wanted 100 positions. If you want only 4 positions, it would be $25 per position. So you can balance out an exact amount based upon the frequency of trades. So as we continue, this particular combination though does work exceptionally well, and it provides a multitude of different techniques that you can use based upon your risk assessment. That is, you can be extremely aggressive with only the moving averages. You can be a little aggressive with only the ATR. You can be a little less aggressive with the ATR DCA combination, or you can be total defensive using all 3 at once, depending upon what you are trying to do. And for the record, this is Jackrabbit TV. So if you're a subscriber of mine, you have access to this automatically. I'll leave the link to my Patreon in the description or pinned comment so that you can actually join and get access to this if you want. This is important because it does a lot of the work for you in a tried, true, and tested methodology. You can see visibly on the screen exactly how you're going to trade before you really trade. And using Mimic to deliver your signals to your cryptocurrency exchange, you get a very clear approach of what to expect with real-world data. So as you progress with your testing, your analysis, your research, I can't emphasize enough the importance of paper trading. There is no other greater resource available to you than paper trading. And this is really one of the most significant ways to be profitable in the cryptocurrency market and to be profitable consistently. Because if you can make it on Mimic with its aggressive and worst case scenario tactics for trading, then the likelihood of you actually making it on your real exchange is going to be significantly high. If you have any questions, please leave me a comment below. Also, if you want to take a look at this chart on your side, just copy this link into your browser. The chart is on sharing, so you'll be able to see this particular implementation. Please give this video a thumbs up, like it, so that I can get this information out to more people and to grow the channel. Thank you for watching.